markets. Thank you so much for joining me on the show today, Bankole. And let's start with how the week has shaped out for the fixed income and FX market, Bankole.
Yeah, good afternoon, Ken. It's not been very active this week on the fixed income end, simply because of liquidity. System liquidity is quite low, given the CRR debits we have suffered in the last 2 Thursdays. Of course, most dealers had in mind, and banks also, the Sukuk bond settlements, which were due for this week also. 150 billion was offered, 160 was sold, and we expect those funds to leave this week. There are expectations that federal allocation meeting will be held this week, or worst case scenario next week. But as we speak, system is quite slightly bearish, reduced activity simply because of reduced system liquidity, like I explained.
All right, we've seen the data point in inflation for May coming out today, and I'd like to get to what you make out of from that, the figures that were released, and how you see this impacting the activities of the fixed income markets, both in the primary and secondary markets going forward.
Okay, thank you. The inch-up, 9th consecutive inch-up in inflation is expected, and we expect this to continue also. However, we are more worried with core inflation. If we check core inflation from last quarter 2019, which was at 9%, 9.5%, it jumped to as high as 11.14. That's backing out food commodities and some elements in energy. That means that generally prices are on the increase, and we also noticed that this increase in core inflation is coinciding with the shutdown of the borders that happened last year around the beginning of the last quarter. So we expect this to also continue to aggravate the situation. However, yields on fixed income securities and interest rates generally remain so low. Even on bonds, the short end of the bonds, we're seeing single-digit yields compared to inflation, which is now at 12.4, turning out a negative real rate of return. This gives cause for concern for most fund holders and people who play on the interest rate. We do not see inflation peaking out right now. We expect it to continue, and then yields on fixed income assets will continue to moderate lower, given the amount of liquidity that is chasing very few instruments that offer.
All right, but let's look at the auctions from today, the bond auction as well, and the primary market auctions. How are investors positioning in these two activities for today?
Yeah, from the bids we saw today, we noticed an aggressive bid from most of the asset management houses, the PFAs, and some banks. The last set of stop rates were 9.2%, 11.7% and 12.6% for 2023, 2035 and 2050 respectively, those bonds. We expect, however, a drop of about 50 to 100 basis points in the yield, in the stop rate this time around, because most of those who were not successful at the Sukuk offer, which was over 400% oversubscribed, will be looking to get very high yields, in today's bond auctions. The results will be released today with the settlements expected on Friday. But basically, these excess funds that cannot go back to the OMO T-bills, which are now, limited or restricted to local corporates, are now chasing very few NTBs, Nigerian Treasury bills, and FGN bonds. And you can see gradually the decline in yields as they stop every month.
All right, now let's look at currencies now. I'm trying to understand if we're still seeing pressure on the Naira, and as well if you see more pressure coming down the road.
The demand has not abated. What we've seen is that because of global lockdown, global shutdown, reduced activities on the FX end, and of late, we've been seeing sales. We've been seeing some, sales of ironing window. There was a time where the ironing window had no supplies at all, but now gradually we're seeing supplies trickling, And then as the economies globally begin to open up, we expect an initial spike in demand for FX, and then subsequently we expect the curve of supply to also meet up at some point, catch up that equilibrium in demand and supply to catch up later. But for now, as the economies open up, we expect demand to exceed supply. Rates are still, at 380. It was at 389 level, but dropped to 385, 386 levels now. So simply because of the marginal amount of sales that are coming into the market. So basically, we expect that to continue. Demand continue to exceed supply, but at a reducing level.
All right, now finally, we're coming dangerously close to the end of the second quarter. I would like to get your assessment of how this quarter played out, and as well what your thoughts are in the medium to long term, looking into the rest of the year.
Yeah, the yield curve we expect to continue to decline on the bonds end. For the Treasury bills end, it's short. On the OMO end, we have 5% trading on OMO. Nigerian Treasury bills just stopped at 3.7 for 1 year. So it's a positive curve. But on the bond end, we expect some more moderation. We don't expect a further crash so much like that on the OMO and the Nigerian Treasury bills end. But the room for correction is on the bonds end. And you're going to see what happens at today's bonds auction, except if the debt management office decides to take in more volume than it has offered, like it has done in the last two auctions. So it's delicately poised, and it's a space to watch. There's more room for decline in yields at the bond auction end and the secondary markets respectively.